Hello and good afternoon, ladies and gentlemen. Coming to you right after the closing bell here today, folks. Um, there's a look at the close as of Tuesday, 4:03. Netflix just reported after hours. It's bid up a good $32. We'll see where that heads in a little bit. But this is our weekly state of the market. This is a special state of the market. This week's is going to kind of talk about some of the historical data that I've been following, some of which has just thrown a signal here at the turn of the year, kind of a fresh start for a lot of investors, and kind of want to deviate from a lot of economic data that, quite frankly, doesn't prove as relevant given that we just passed another fiscal stimulus package or relief package, and there may be yet another one on the way. We can already see in the credit card data, the debit card data, that a lot of those $600 checks are already being put to work in retail sales. That's probably going to have a nice pop. The December retail sales were rather abysmal, but they're probably going to have a nice pop here in January. And since the $600 checks and the increased unemployment insurance benefits. So for this week's State of the Market, which is happening on a Tuesday, this is a holiday-shortened week, so we're kind of taking care of a little business ahead of time, but it's also in a very timely manner because, as I said before, we're looking at some of the historical data studies, and some of them just completed as of the end of the year and into the first trading weeks of the new year, as well as today. One particular study just completed its signal as of Tuesday's closing bell. So why do we look at the historic data? To study the history of market behaviors and or the performance puts the average investor at an advantage when compared to the lone wolf approach to investing, which frankly, folks, you want to stay away from that. You need a team of resources, you need feedback systems, you need, idea generation. And if it's all, egocentric, it tends to, lend itself poorly over time. So build your resource is something that we promote constantly here at Phenom Group. The markets are more dedicated to disseminating human behavior than they are price discovery potentials. While circumstances are seemingly always different, always unique, human behavior proves the one most constant variable in the financial markets. And that's why we study the historic data. Because look, 9/11 was its own unique set of circumstances. The great financial crisis was its own unique set of circumstances. The pandemic has been its own unique set of circumstances. However, when you look at history, when you look at charts coming out of deep recessions or deep bear markets that happen relatively quickly, you'll find that, coming out of those particular cycles, the next or the start of a new cyclical bull market tends to mirror what has happened in the past. Why? Because the market is generally an expression of human behavior, humans engaging with price action. A lot of investors and traders learned this truism about financial markets just this past year, some for their betterment and some not so much, as they fought against market history, against human behavior, basically. This chart right here, this is the 2009/2020 analog. Look at this. This is the bear market in 2009 in green, the bear market in 2020 in yellow. And yet they followed the same path. There were some slight deviations here and there, but dips happened almost exactly when they happened in 2009 as they happened in 2020, and the rally or the Santa Claus rally into the new year. Almost identical. Again, this is just validation that human behavior, regardless of the circumstances, tends to mirror the past. And again, that is why we study the historic data. So what happens now? We've turned over a new year. It's the turn of the year. It's 2021. So far, moving into 2010, the market has mirrored what we saw in 2010 so far. Now, having said that, this is where the market's supposed to take about an 8% correction as it did in 2010. Will that happen? Remains to be seen. Again, there were some gaps here, some deviations in the 2009/2020 analog. So it doesn't always happen on the precise day. This particular dip started on 119. Well, here we are, 119 in 2021. The market finished nicely positive here today. So the deviation may have shown up just here and now. So we can travel along the same path, you know, when looking at these analogs, but sometimes we have a different plane. Same path, just a different time plane. But again, over time, it does tend to mirror. We'll see if the 2010 analog is a good representation for how we should be guided here in 2021 soon enough. That's a good thing with these analogs. As long as you know that they exist, you've studied them, you can also pinpoint when it's just not useful anymore and the market's kind of doing a new, you know, a new representation of human behavior here. All right, so again, we just turned over the year, right? We're in almost the third week here of trading in 2021. The turn of the year has a really strong signal. Wayne Whaley was a quant before quants even existed. Very famous quant. There's even a breadth thrust named after Wayne Whaley called the Whaley Breadth Thrust. He has a math background and has been managing money since basically the late 1980s. Now, his goal when trying to find the most, how can I find the best guide for, future market returns? So he basically used the calendar, and he was looking at all the different time frames for what threw off the best signal for forward returns. In other words, what gave the greatest probability for S&P 500 returns going forward. He implored his computer to take a few seconds to exhaustively study S&P 500 performance over every time period of the year and determine which time frames behavior was proprietary or of the highest correlation coefficient relative to the following year's performance. Here's what he found. What he found was there was a high correlation between the S&P 500 returns from the dates of November 19th and the following January 19th. So we just wrapped up 2020. So from November 19th, 2020 to today, January 19th of the new calendar year. We just turned over the year. This is the date that he found that threw out the greatest probability predictor of S&P 500 returns going forward. And since the 2-month period straddled the turn of the year and the gift-giving season, he called it the toy barometer. Turn of the year, gift-giving season, holidays for those of you who have kids, friends, loved ones. You gave out a bunch of gifts. So this is Wayne Whaley's toy barometer. And it basically measures the returns from November 19th to January 19th, and then gives a predictive value of forward-looking returns for the S&P 500 12 months out. So again, here's the calendar, November 19th, and if it falls on a weekend, you basically just use the next Monday. Now, for November 19th of this past year, it did not. I think it was a Thursday, so it's all good. It's easy. You don't have to do, change your calculations or anything. And here, January 19th is a Tuesday as well. Now, in his study, he's only considering price returns, not including dividends, folks, not including dividends. So if the return during this 2-month period, November 19th to January 19th, if the return during this 2-month period was greater than 3%, a bullish signal was given, and the market was very likely to do very well over the following 12 months. Now, if the return over that 2-month period was 0 to 3%, this signal was considered neutral. and results were somewhat random and in line with what is considered the average return. And if the return was negative, so below 0%, you had a negative return, this gave you a bearish signal, and returns tended to be very poor. So let's look at the bullish signal. It has given a signal 35 completed times going back to 1950. All right, this study goes back to 1950. There have been, 36 bullish signals, including last year, 2020. So let's look at it, folks. 2020, right? 2019, November, to the turn of the year, 2020, January 19th, we did have a bullish signal, yet we still had a bear market. It just goes to show you, when an exogenous event happens, you can't predict it. However, return on the S&P 500 last year was 16%. That includes dividends, so we'll call it 14.5% without the S&P 500 dividend. That's still a nice double-digit return with this particular signal. The average and median gains of the 12 months following the bullish signal were about 17.7% and 15.1% median. Here you go, folks. Here's the chart. 2020, we did have the bullish signal. We finished with 14.5% return. Folks, this signal has fired bullish 36 times. This year makes 37. Of those 36 that we know and have completed the forward 12-month returns, only twice, 2018 and 1987, has the market delivered a negative return. What is so awesome about this study is that means 36 signals fired bullish. Only 2 times was there actually a negative return after the bullish signal. So this study has a 94% positive rate. What did I say earlier? Wayne Whaley was looking for the most correlated forward-looking returns based on time frames, and he found it. 36 times this fired bullish. It has a 94% positive rate of forward 12-month returns with an average return of double digits, 17.7%. So last year, we technically underperformed the average, but still 94% positive rate. Do not miss that, folks. Here we were coming into today's trading session, January 19th. We were going to complete the signal, the toy barometer signal here. We were up 5.6% coming into today from November 19th, up 5.6%. Today, market finished up nicely, about 0.8%, we'll call it. So today we completed the 37th bullish signal for the toy barometer. And again, 94% positive rate, double-digit returns over the next 12 months according to this study. All right, so there's some more data here about the bearish signals and the neutral signals. But even the neutral signal, again, it's more often than not you get a positive return. Let's see here. There have been 19 neutral signals going back to 1950. The following year was positive 12 times, folks, or 63% of the time. So still above average, Bearish signals, there have been 16 bearish signals. Only 6 of the following years posted a gain, while 10 posted losses. This is a really affirming, data study by Wayne Whaley with a 94% rate, and we just threw off a bearish signal at the closing bell here today on January 19th, folks. Here's another one from Wayne Whaley. This is his breadth thrust. In 2020, the S&P 500 put up 2 Whaley 10-day 2x1 breadth thrust. That's advancers versus decliners. So when advancers are greater than decliners by a measure of 2 to 1, so for every 2 stocks advancing, there was 1 stock declining for a 10-day period, it equates to a Whaley breadth thrust. It's a signal that there's a, you know, a strong bullish momentum in the market. In the furthest column to the right, we see the positive market return rate here, folks. Let's see, up, down. Here's the 12-month forward looking earnings there. This chart gives us a little bit more clarity here. And as we can see, we scroll down to the bottom. 2 times this breadth thrust signal in 2020. Once there, I think that's June, and then once again in October. And when we think about these studies, we want to know what the forward returns are, and we want to know what the positive percentage is. So the average return, and this is 1 week, 2 weeks, 1 month, in the third column, 2 months, 3 months, 6 months, 1 year. So we'll start at the 1 month. 1 month after the signal, the positive rate, 79%, 2% return. 2 months out, 4%, 87% positive rate. 3 months out, 6 months out, 87% of the time positive. 87% the market has a positive return. 92% of the time, the market has a positive return 12 months out. The average return, 13.7%. Again, these are both Wayne Whaley studies, one a breadth thrust, one called the toy barometer. We're looking at these positive percent rates. These tell you a lot about investor appetite. It tells you about the momentum in the market and the feelings that things are going to improve. So these are very strong signals. A lot of times these do come after, you know, sharp declines in the market, whereby it gets bought up because you have fiscal policy coming to the rescue, or you have monetary policy coming to the rescue, so on and so forth, as we did in 2020 and still do going here now into 2021. Market correction hawks. So while we see all of these, you know, positive studies, indicators of forward-looking returns, that doesn't stop the drumbeat of, you know, market correction calls. We've been hearing them from Mike Wilson of Morgan Stanley for the better part of 6 months now. We did have a garden variety, you know, like 10% correction there intra-year after, you know, we had this nice rebound into the summer months for the S&P 500, a 15% correction there in the Nasdaq. So we have had a pretty material, you know, correction and dip buying opportunity nonetheless, because it tends to happen every time you melt up, you know, and you have the Santa Claus rally into the new year and it still doesn't fade. These analysts and strategists continue to beat the drum for a more material correction to happen. Craig Johnson has been calling for a market correction, you know, since November. Guy's been calling for a test of the 200-day moving average. He was just out on CNBC last week. He's calling for, and he doesn't say, you know, he says 16% correction this go around in his latest interview with CNBC. And I want to kind of just play a, you know, quick clip here during that interview.
We think a setback and then a correction. And Frank, I'd add one other thing in here too. If you go back and you look.
File with the help of an expert.
Of course.
Let an expert file for you. Intuit TurboTax Live.
The secret to making a tasty turkey pinwheel?
Come on, YouTube. You can do it. There we go.
Any sort of first year of a new presidential cycle, you have typically seen about a 5.8% return in a given year.
5.8% return in a new president's first year cycle or administration. 5.8% return.
But you also see a drawdown, a little over 16% sometime during that year.
16% max drawdown during that first year also.
That's the correction that we're looking for, that we think ultimately should be bought.
Now, it just so happens to be, in the past, he's calling for a test of the 200-day moving average, all the way back in November, folks. Guess what a 16% correction takes you down to? It just so happens to be the 200-day moving average. Go do the math, folks, on the S&P 500. See for yourself. A couple of reasons why Craig Johnson of Piper Sandler keeps, issuing these, market corrections, this test of the 200-day moving average, is that rates are rising, which typically proves a headwind for equities. First year of a new presidential year historically delivers only a 5.8% return. Also see a drawdown of 16%, as he said there in the video. Let's dig deeper. Is this just a new, first year presidential cycle? Or is there something more that we can add? Another layer, another variable I think there is, in the way of this is a blue wave. A blue wave came out of the recent election, which tends to bode well for the market, historically speaking. In fact, this is the 9th new Democratic president since 1900 to bring with them both the House and the Senate. Why so many blue waves, you might be asking? Well, 10 of the last 11 recessions occurred under Republican administration. That's just the data, folks. I'm not trying to be partisan here. It's just the data. Don't shoot the messenger, as they say. Historically speaking, stocks do quite well the first year with the blue wave. And that's where I think Craig Johnson may have missed a variable. He missed an input. This is a blue wave, even though it is, quite frankly, still a very, very narrow majority in the Senate. Even the House lost 3 seats during this election. All right, so as shown in the LPL chart, when a new Democratic president has brought with them the House and the Senate, stocks gain that first year of their new presidency 6 of 8 times. So its positive rate is 75%. The average return, again, a double-digit return, about 11.9% there, folks. The variables matter. You have to have the appropriate inputs. And I think Craig dropped the ball. Doesn't mean we can't only get a 5.8. It doesn't mean we won't have negative returns. But history is our best guide. It's human behavior. We want to align with the greatest probabilities as an investor, as a trader. Here's yet another way of looking at a new presidency with respect to market performance going forward by quantifiable edges. This study eliminated inaugurations of presidents that weren't elected. So, for Gerald Ford in 74, Johnson in 63, Truman in 45, and Coolidge in 23. The same sense of excitement isn't generally generated by a replacement president as by a newly elected president. So when we look at their study, this is the Dow Jones performance on and after inauguration of first-term presidents. And as you can see here, on inauguration day, not so good. Again, this is the Dow. Most of the time negative. And if you do the math here, it's about 0.70% that the Dow is down on inauguration day, going back to 1953. I just went back to 1953, World War II. That's where I like to start my studies because I think it's at least in keeping with some of the change from, an agricultural economy to an industrial economy. Obviously, now we have an information technology and consumer-driven economy. But going back to 1953 on inauguration day, the results aren't good. It's down 0.70%. The last time it was positive was Donald Trump's presidency or his inauguration. Now, the next 10 days, percent change, it gets better. The optimism comes back. People feel, this is new, this is better. So, the market tends to perform better the longer we extend our time horizons. The next 75 days, which is the equivalent of basically three trading months, it gets that much better. As you can see, there's a lot of green on the screen. 58% here during Roosevelt. That was the bank holiday. Markets were shut down, so it definitely skews the overall performance. But there's still a lot of positive. Only 3 times was the market down. Going all the way back to 1921 here, some 3 months out. So, all right, looking out over the next 10 and 75 days, the market did often seem to embrace the new hope that comes along with a new administration. Now, something we've been talking about in our research reports is, look, if you've been fighting this equity market rally since the March bottom, you've not only been fighting the S&P 500, Dow, and Nasdaq, you've been fighting the whole of the global equity market rally, folks. You can see here the MSCI and the All-Country World Index relative performance to the S&P 500, as well as, if you extrapolate the US ETF, here's the performance getting to a new all-time high here. Basically, the all-country world index and MSCI, folks. This is the global 100 index. Again, new all-time highs and breaking out pretty strongly, significantly. You're fighting the world if you're fighting this equity market rally. The global Dow made a new all-time high recently. So let's also look at another study here from the German DAX. The German DAX hit an all-time high, folks, on, I think it was 1228 here. It also hit one earlier last year in January. But here, at the very end of the year in 2020, it made a new all-time high. Now, I don't care about the DAX, and if you want to, invest outside of the U.S., go for it. Good on you. If you have that kind of skill and dedication, and that's, in your wheelhouse, good on you. For me, it's not. So all I really care about is, what is the DAX making a new all-time high portend for the S&P 500? So here was the last time it made a new all-time high. S&P 500 index. 1 week later, after the DAX makes a new all-time high, the average return is 0.92%. Folks, did that happen? Indeed, it did. History repeated itself. 93% positive rate. 2 weeks later, up 2.2%. We got up almost 2% and 100%. But last week we actually gave back 1.5% in the S&P 500. One outlier, it happens. 1 month later, positive rate 87%. Almost 2% return. 3 months later, average return 4%, 81% positive rate. 6 months later, up 6%, 78% positive rate. 1 year later, that's the one I don't like. It's basically a 50-50 shot, but the average return, 9.27%. Don't fight the whole global equity market, folks. Don't do it. Now, these signals just happened. So that's why I say kind of doing this state of the market in a very timely manner, because we have signals that just happened. Not just the toy barometer, which just completed and threw off a bullish signal, but this one here. When the S&P 500 closes 2 weeks ago at an all-time high, right? The first week in January, we made a new all-time high. And then the following week, we put in a red candle. Basically, we had an inside week. So this study comes to us from Steve Deck. Now, when this happens, right, we made a new all-time high 1 week, and then we had an inside week, which is a red week. What happens going forward? Well, this is the red week that we just had after a green week. 1 week later, which is the week we're in right now, the third week, the average return for that third week, 0.32%, 61%, we'll call it 62% higher. So, it's not a barn burner. 2 weeks later, not so great either, but more often positive than not. 3 weeks later, it gets better, and the positive rate is that much higher, above 71%. 4 weeks later, we'll call it a month, market is up 0.77%, still almost a 67% positive rate. This, again, just happened. No barn burners here. It looks like a lot of sideways trading, if you ask me, and that might be what we're in for, here in the back half of January, keeping in mind that there are headwinds, seasonal headwinds in the back half of January. And then at the very end of January, we tend to start to rip to the upside once again into the month of February. And keep in mind, folks, we are in the best 6 months of the year to own stocks, which starts in November and ends in April. Best 6 months of the year to own stocks. The market historically going back to 1950, up 78% of the time during that 6-month period with an average return of about 7%. Love your data, folks. Love it. All right. This one here, this one brought to us from Chris Shivako. Great video. We watched the Nasdaq 100. This pertains to the Nasdaq 100, the percentage of stocks trading above their 200-day moving average. Now, this signal is, when it goes all the way below about 24%, meaning the percentage of Nasdaq 100 stocks trading above their 200-day moving average drops below 24%, but then rises to above 85% of stocks trading above their 200-day moving average. Only a couple times in the past has this signal fired. The forward-looking returns are fantastic. 1 month later, 100% of the time, the market is up. This is the 7th. So this is what the Nasdaq does, but how does it relate to the S&P 500 performance following this kind of breadth thrust, if you will? And it just completed, got to above 80, got to almost 88% of Nasdaq 100 stocks were trading above their 200-day moving average right here at the end of the year. And there's still, close to that same percentage of stocks is trading up there. How does it relate to the S&P 500 performance going forward? After this rare round trip down and then up, down and then up here, that's 2008 or 2009 here, 2003, and then in 13. Every time, 100% positive rate for the S&P 500. Here's your average return: 1 month, 3 months, 10 months, 6 months, 1 year, 2 years. Look at these returns, 100% positive rate across the board. This just happened. Your data is telling you something. You live by the historical data because it's a representation of human engagement with the market. Circumstances always change, but human behavior, that's a tough nut to crack. With that, I'm Seth Golden. This is Phenom Group. Come and visit us at Phenom Group. Subscribe to get all of our weekly research reports and access in a real time as we deliver it to our members, our State of the Market videos.